going on, everyone? Today we're going to be discussing exactly how we can earn $100 a day through dividend and dividend growth investing. So the portfolio is sitting at around $8,000 over here, and this is going to be important for one of our steps in the next steps in terms of our analysis. To earn $100 a day, we're talking in 365 days, $36,500. And when we look carefully over here where we go to research in terms of M1 Finance and go to My Pies, you can actually navigate, and for that same pie we were discussing, DGI-esque, the reason for that name is because there's dividend growth investing stocks as well as some who had dividends but not anymore, and they're all included in this DGI portfolio. And as we look carefully here, these 69 holdings are giving us a dividend yield of 2.353%. My apologies there. And if we copy paste this, we know that we're starting at around an $8,000 balance and have a dividend yield of this much with our 69 holdings. And this expense ratio over here is essentially saying that there are some management fees that are there for certain ETFs and otherwise. For example, QQQ over here, Noble, the SPY, and there may be some others right here in the 69 holdings that are here in this pie. So now if we take this and go to a dividend calculator, which you can easily find online. This is here on marketbeat.com, not affiliated with them, just sharing. This is a sample of them saying, hey, you have a portfolio in terms of your investment type. You can do this to kind of mirror an individual stock, but you can say for the investment portfolio type, or type being portfolio, starting balance over here, they have it as 100K. And for this $100,000, if you had a 5% yield in terms of dividend, and in a taxable account versus not, for example, if this is in an IRA, versus over here, the assumption being in a brokerage account. So your annual contribution of $20,000 is the assumption here. You got 3% in terms of your expected annual dividend amount increase, and with the starting yield here of 5%. Your distribution frequency assumed annually in terms of annually versus monthly versus quarterly. They have a dividend tax rate of 15%, an expected annual share price appreciation of 3%. DRIP, which stands for Dividend Reinvestment Plan, is yes or no if we're reinvesting dividends or using them to be used as cash, for example, on certain expenses. You have tax-exempt dividend income allowed per year, so if that situation applies, you would increase this percentage accordingly over here. And then you have years invested, the assumption being 20. So after doing all this, if you press calculate dividends, then what we notice is the calculator will give us a result, and the result essentially looks like this. So after 20 years, you'll have $1.2 million and more, total return of 150% almost, an average annual return with the metrics we provided of that much, these ads. So 4.68%, then you have annual dividend income after 20 years with this type of contribution of 62 grand and change, and total dividend payouts of over $500,000, and yield on cost being almost 12%. And yield on cost is essentially saying that, hey, our dividend that we said in terms of current yield was 5%. But as we kept going and going, and the dividend in terms of what it's giving us is increasing, this 3% over here and compounded over 20 years, essentially over the years and all the calculation that goes into it, we're looking at 11.93%, which is pretty great, saying a dollar today in the future would give us 12 cents back every single year. And naturally, if we change this to, let's say, 40 years in terms of the long term, if this was sustainable or the way the plan of action was intended to be, if we scroll down, of course, to go over the numbers, do take a look. Your average annual return may not go up that much per se, but yield on cost is 31.17%. So pretty impressive from that fashion. And as we scroll down, we can actually see a kind of deep down drill down view of how this looks like. So for example, each year, what is our principal? What is actually happening here? So even in year one over here, you can see where we put in that $20,000, but look at this, just the dividend itself adding on makes that principal that much more. So this can definitely be a more dense view. Feel free to pause and check out how this kind of goes, or kind of go to this site to see your own description. But now plugging in our numbers with the current portfolio we went through at the beginning of this episode/video, we're going to be looking at numbers like this. So this pre-fill total over here is just going to be that same ending balance of the initial what's put in there, but putting our numbers in, our parameters, you got $8,000 in terms of principal, portfolio type for sure, an annual dividend yield of 2.353%, which we brought over from the fact that it tells us it's exactly that much. And this is a taxable account, the DGIS portfolio that I share. At the current time of this recording, we got $200 going into that portfolio every single 2 weeks. So $200 every 2 weeks is $400 a month times 12 months. We're looking at $4,800. And at 3% annual dividend amount increase, now depending on how that portfolio is structured, this percentage could be a lot more with certain stocks I know that exist in that portfolio, but there's also balance in terms of keeping a sustainable, kind of predictable cash flow situation. And so, with that being said, if we say 3% is our annual dividend amount increase, essentially matching inflation, which is on average 2 to 3%, in this situation with distribution frequency being quarterly, which is usually the cadence of most dividend stocks, but some are semi-annual, annual, as well as monthly. Then you have dividend tax rate of 15%, which is a common metric used for dividend taxes, or rather the income received through and from dividends. You have share appreciation. Of course, it can go a lot more to increase the portfolio overall, but in this situation, we're just assuming 3% similar to the dividend amount increase. DRIP, yes, we're reinvesting our dividends, not meant to at this time be used for external expenses to be taken out of the portfolio and otherwise. So with that, we're saying yes. Tax exempt, we'll assume 0 for now. And instead of 20 years from the base case, I wanted to put 10% over here just out of curiosity to see what and how the situation looks, and also to aim in a certain way where I myself at the current time of this recording also don't want to wait 20 years, frankly, even though that would be, let's say, optimal, especially for a DGI investor. So as we press calculate dividends, it will load. And what we see here are the results in front of us. So after this many years, after 10 years, assuming our parameters, we'll be looking at an ending balance of $73K, $477.20, total return of 31% after this many years, so 10 years on the portfolio. We have an average annual return of 2.75%, an annual dividend income of 1.74423 so $1,700 and $44.23. Total dividend payouts over the years of 8K and change, and yield on cost of 3%. And we started off with a yield of 2%. So essentially after 10 years, we're actually getting into that 3% range in terms of our dividends. So if we lived on our dividends itself alone, the thing is, with this much income of 1,800, if we divide this by just even roughly 400 days in a year, you're looking at $4.50 a day. And with that, we want to aim for $100 a day. So essentially, with that being the case, what would I need to do today in order to get our portfolio here of $8,000 to where we're looking for in terms of this annual dividend income amount being, specifically speaking, $36,500? Now, we have a couple choices. We can either increase our expected yield overall. We can also assume different parameters in terms of our share appreciation. Now, annual dividend yield, it's what it is today. This is just a sheer fact. And of course, I can change the holdings to make this more today, but maybe these parameters would change accordingly. Annual contribution is the thing that I see that is the most realistic to change. Just in other words, add more money to the pot and try to adjust how we can aim towards that direction. And like that, I won't change any of these. Taxable account, I'll assume that's the case. Of course, with an IRA, you have a 6K at the time of this recording maximum per year contribution-wise. But at the end of the day, I'm looking at contributing more than that, but also to create a certain level of dividend income, which 6K without taking certain type of risks or assumptions of how much yield could be given in the long term, where the market, its previous returns may not influence what's given to us in the future. So without using that as a benchmark as we continue, DRIP over here is yes, quarterly distribution. So let's say that we can actually choose to contribute a little more. But let's also assume that I know that 3% in terms of what's in the portfolio and 3% in terms of growth is not exactly the most realistic or unrealistic. So I also do know that, let's say that this growth amount is 5% conservatively, and these are still conservative numbers. And let's say that our expected share price appreciation, instead of it being 3%, let's also say it's 5%. And this is because the S&P 500 goes up 7 to 8%, which is also one of the big kind of key holdings in this portfolio. So I can definitely and will increase this amount to see, hey, based on our current contributions, how much more does this go up by? So with this being said, in our 10 years, if we say calculate with the same parameters as of today, we go from 1744 to 1949. So a couple $100 extra with adjusting these percentages just by a couple. and our yield on cost goes up to 3.35%. The ending balance of 82K, it's a little more than that 70K's type of figure, but it's not really moving the needle. And so if I expect, let's say, that same kind of, let's say 7% and 7%, this is kind of a reach, but let's say it's also realistic because some years are more than others. And the annual dividend amount increase, it can also be more, it just depends. So if we say calculate, we go from 1949 as we scroll down, another couple, almost 300 bucks extra. So actually a lot more because of those percentages, and of course time would take us further. So let's say our annual dividend amount increase, let's fix it at 5 on average. Let's say our share appreciation for whatever reason is closer to 6. Let's just be conservative. Let's say both at 5. Now the difference here is I definitely would need to add more money, and that's probably realistically what needs to happen. Now, if we make this from 4,800 to 9,600, then let's see how much this changes. So this is more conservative 5 and 5 at $9,600. We're looking at an annual dividend income of $35.25, and we're looking to actually do this tenfold, right? So if we increase our annual contribution tenfold, of course we could get there even faster just through compounding, or we can say that, hey, if we say maybe in year 17, let's see how that looks like. Are we going to break our figure? And an annual dividend income, yeah, it goes up, but not really. So if we now take 9,600 and let's just keep it around $20,000. Of course, if we bring this down to now 10 years, how are we looking like? If we go over here, we're back at the 6K, 7K number. So now, if we make this 20 on a conservative time frame at 5%, with an annual contribution of 20K, you're almost there at $100 a day. So here, this is an annual contribution of 20 grand, but still at this annual current yield of 2%, it's because we're starting here, we're starting lower, that it feels that much more in terms of what's needed to be happening over here to get where we're trying to go. So in terms of where I truly think that this portfolio can perform, I'll say an average dividend increase of 5% on the conservative side. But if I'm being realistic, I think that, hey, 7% with this portfolio and what's in there, but our appreciation may not go up too much. But let's say at a blended rate of no more than, let's keep it at 7%. And then the annual dividend here, let's say it's really actually closer to 9% based on more technology holdings. Now, with this being the case, this is obviously a huge assumption. And let's say I can contribute, let's say $12,000, which is $1,000 a month. How much does this move the needle in 10 years? And this is the base case. So with this would have 5,000 and change in dividends. And for me to really make this happen, I guess it all depends on what I would need to do here. So in 10 years, if I really wanted this, if I want to put 24, so 2K a month into this dividend growth investing portfolio that I have, I'd be at 11K. So I need to make this $72,000, and probably I would hopefully be almost scratching it. So this is with $3,000 a month with these type of expected returns over the next 10 years, you're looking at this. So if I add, let's say, annual contribution of 75 grand, and we return the page, calculate dividends, then we'd be looking at almost the figure we want. So let me make this 78, and hopefully we'll get to what we're trying to do. So over here, when we do this and refresh, we get 34,898. So let's make this a clean 80 grand, and this should be what we're trying to aim and look for. So let's hope for the best here, and enter. And 35,779. So I'll accept this as the figure. Turn almost 100 bucks a day. So obviously it's going to be a little more than this, but you can definitely adjust some of the parameters and hopefully get what you're aiming for and looking for. So with that, thanks for coming to the end.